Are you potentially overlooking your biggest and best retirement asset?
Joyce Palmer provides wisdom on wealth, empowering women to be proactive and make safe, smart, and simple financial decisions. Welcome to Proactive Woman, helping create financial legacies for ladies. Oh, and men too.
This is Joyce Palmer, and you're listening to the Proactive Woman podcast. And we are talking about overlooking perhaps one of your biggest and best retirement assets. And I'm super excited today because in the studio, I have a guest person, and you guys look forward to hearing this. So, Don Graves is the president and founder of the Housing Wealth Institution and an instructor of retirement income at the American College of Financial Services. And he's an awesome presenter, and he's a wealth of knowledge on this topic. So you're in for a treat, listeners. Don Graves is here, and we're going to ask Don that question. Are you potentially overlooking one of your biggest and best retirement assets?
Well, good morning, Joyce, or good afternoon, where I don't remember. And I'm so thrilled to be here with you and Jerome. I happen to be in Charlotte today. I don't get out here very often. And I said, oh my gosh, let me just go by and say hello to them. And this is a delight. When we talk about a person's biggest asset, right? And I have to be careful how I say that. I was in the Baptist church one time in the basement. And I said, Miss Jones, you got a big asset. And the deacons put me out. But what are we talking about? We're talking about in retirement, you have to use all available assets, AAA advisor, all available assets. So client's income, their insurance, including annuities, their investments, 401k, brokerage accounts, IRAs, but their housing wealth.
Housing wealth.
87% of retirees live in a home, own a home, 87%. And the U.S. Census Bureau says that the average married couple, the average retiree, has less than $100,000 saved. Now, that may not be your clients, of course, but just an average. But they've got a home that's $200,000 plus, and you just look at the last 2 years, and that's really gone up. So the largest concentration of wealth that retirees have is in their housing wealth. So here's the question. If I've got a plan for a retirement that's going to be long, uncertain, unpredictable,
right?
Does it make sense to use all of my available assets to develop a plan? Or let me say it this way. Does it make sense to overlook housing wealth when developing a retirement income plan?
Right.
And so that's what I do. I help retirees and their advisors to say, what do we do with this housing asset that helps strengthen my retirement outcomes?
Wow. Housing wealth. And when you think about it, it is the biggest asset for many people. Their home value is right up there with their 401ks and their IRAs. So you certainly would not overlook using your 401k to help you with your retirement. So why would you overlook your housing wealth?
Sure. So many people do. Or let me say this. We know how to use our housing wealth in our early years, right? There are really two ways to use your housing wealth. You sell and move, and then you've got this lump sum of money. So either you move into another home, or you go to an apartment, move in with, but when you're younger, or you take out a mortgage, a 30-year mortgage, when you first buy a house, and then when you want to do repairs and the kids to college, you get a home equity loan or home equity line of credit. But now, when your income goes from steady to fixed income because you're retired, what's an age-appropriate equity release strategy? Meaning, how do I get money out of my home now? Well, I don't want to move. I want to live here. It's my home. Number two, I don't want to have a monthly mortgage payment into my 80s or 90s. And so the idea of, is there a way to get money out of my home without having to move or make monthly mortgage payments, is where the concept of equity release for retirees came into. Now, a common word is reverse mortgages. That's isn't that something, right?
What's that?
Well,
reverse mortgage. I've heard bad things about that. What is
that?
it?
Listen, someone said, Don, what's a reverse mortgage? I said, it's a good way to get stabbed at at the barbecue, because you were over there with cousin Tracy and everybody's having dinner, and someone said, I'm thinking about mama getting her reverse mortgage.
Oh no.
And three people left the table, and your Aunt Janie made a shank out of a plastic knife and fork and came after you. And they say, well, and you gotta say, whoa, wait a minute. And I tell people, say, Don, what is a reverse mortgage? I said, let me give you 4 words that will help you. I said, now, if you're watching or listening, I want you to write these 4 words down. You ready? IJAM. IJAM. It stands for it's just a mortgage.
It's just a mortgage.
Joyce, it's just a mortgage. No, don't make it spooky, right? Someone says, well, explain it. I say, well, listen, 2 retired people wanted to get money. So one goes to the bank and they both said, well, we'll just get a home equity line of credit. So they go to the bank or the lender, they present qualifying documentations, income and all of that. And they both get approved for a $200,000 line of credit. They go out and spend it. One buys his granddaughter a Princess Diana wedding. The other one buys a small yacht, and they spend the money. The following month, they both begin to make monthly payments. And after 10, 15 years, the loan is paid off and closed. So here's my question. One of them had a traditional home equity line of credit, and one of them had a reverse mortgage. Can you tell the difference? Well, the answer is no, Don. You've described the same thing. I said, that's right.
It's just a mortgage.
It's just a mortgage. See, the difference is a reverse mortgage is a federally insured loan for those age 62 or better. Now, there are other proprietary products for age 55, but let's just focus on the standard one, the federally insured. It's called a home equity conversion mortgage. That's the legal name. So it's a federally insured loan, been around for 34 years. So it's not a new program for those age 60.
I heard federal. That means it's governed, it's protected, it's legal.
That's right. Okay. It's one of 3 programs that the federal government has to undergird retirement. And all 3 of these programs are really spooky. The first one is Social Security, 1935. The second one is Medicare, 1965. And the third is called the Home Equity Conversion Mortgage, 1988. So these are 3 programs sponsored by the federal government to undergird retirement. So a reverse mortgage is a federally insured loan for those age 62 years or older that allows them to convert a portion, just like a home equity loan, you convert a portion of your home's value into tax-free dollars that you can use. Now, here's the difference. You don't give up ownership of the home. You're not required to make a monthly loan payment. You don't come off title. So now a home equity line of credit, you've got access to dollars. You use them however you want. There's no payment required. No monthly mortgage payment required. So when does the loan get paid? Well, like any mortgage or home equity loan, typically the loan gets paid when the last surviving borrower has permanently departed the home. You move or you decease. At that time, whatever the loan balance is, gets paid from, usually from the sale of the property. Now watch this. And 100% of the remaining equity passes on to the heirs or the estate. And so to the listeners or viewers, as Joyce said brilliantly, if you had a 401k saved up, wouldn't you be thinking about how do I use that to help my retirement? If you had an IRA, if you had any asset, you would say, how do I strategically use this thing to strengthen my retirement? Well, you want to do the same thing with housing wealth. So it's not spooky, and you're going to see it's very powerful when used in the right way.
So I heard, and Don, this is great stuff, because in helping our clients plan for their retirement, one of the first things we do is we sit down and talk about all of their resources, and we start building their income bucket. You need to make sure you have enough income to live your entire life. And we don't know how long that's going to be. So we want income for life. So what are your assets? What are your resources that we can use to build this income bucket? So immediately, like you said, we think of 401ks and IRAs. But a lot of times we're not thinking about the asset that we're living in, that we're sitting on literally and not utilizing.
Right.
So I heard that it's just a mortgage. It's not this spooky, scary thing that's gonna, come and scoop us and take us away. It's just a mortgage. And I also heard really loud and clear that it's federally insured
Sure.
loan.
That's right.
Guys, that means that it is legal. It is a tested resource that the federal government has put out there for the benefit of using it for retirees.
Absolutely.
So when we're not capitalizing on it and using it, we're literally doing ourselves a disjustice.
Sure. And because we hear stories, right? And how many of you watching have heard a bad story about a reverse mortgage? And sometimes it happens. You were over at the barbecue.
That's right.
You were at cousin Tracy's house, and Uncle Junebug came out of her spare bedroom. And somebody said, Uncle Junebug, what are you doing in cousin Tracy's spare bedroom? Now listen to this. He said two things. He says, "Oh, I got a reverse mortgage and I lost my house." And everybody says, I knew it. And they go to church on Sunday, and right after Sunday school, they say, I was over my cousin Tracy's house, and Uncle Junebug got a reverse mortgage. He lost his house. And then Monday, people went to the barbershop and beauty salon. They said, I was over at a friend's house who had an uncle who got a reverse mortgage, lost house. And now by the end of the week, that story has gone all over town. So people say reverse mortgages, oh, that's bad, that's terrible, that's spooky, because of what they heard about someone. Let me tell you something. That story about Uncle Junebug, he got a reverse mortgage, he lost his house. That's absolutely true. 100% true. But he didn't tell the whole truth. See, when you get the whole truth. See, let me give a few mechanics of a reverse mortgage.
Okay.
So the amount of money you get is based off of three things. It's a triangle here. That's not Illuminati. That's just a triangle. It's not JC. It's based off of three things. If you're writing it down, I want you all to draw a triangle.
Okay.
And number one is based off the age of the youngest borrower. The age. Number two is based off of your home's value.
Home value.
And then number three, it's based off of the expected interest rate or the long-term interest rate. And that's going to make a certain amount of money available in the middle of the triangle. You can go to www.housingwealth.net to get in contact with me, but you all know Joyce and Jerome, just reach out to them. And so that's going to give you a certain amount of money in the middle of the triangle. If you've got a mortgage or home equity loan, we put that underneath the base of the triangle. So you put minus $100,000 or whatever you owe. So the number in the middle of the triangle minus whatever's underneath the bottom of the triangle equal symbols, your existing line of credit. Now, when you get a reverse mortgage, let's go back to Uncle Junebug, because I said he told the truth. And that shocks some people. What? He got a reverse mortgage and lost his house. That was true. That was absolutely true. There are 4 requirements of a reverse mortgage. You all listen. These are spooky. These are dangerous. And I don't know if most people can handle this, but I'm going to say it anyway. Number 1, you have to live in the property.
You have to live in a property.
At least one person. So if you're married, you can put your husband out, but you gotta live in the property.
Now, ladies, you heard that? I didn't say it this time. Dawn said it. But
you got to live in the property as your primary residence. Number 2, you got to take care of it. Number 3, you have to keep homeowners insurance. And number 4, you have to pay your property related taxes. Now, 4 things: live in it, take care of it, homeowners insurance, and taxes. Now, most people say, well, Don, that's not spooky at all. I said, it's not. But when Uncle Junebug told the story, he said, I got a reverse mortgage and I lost my house.
Okay.
And everybody at the barbecue said, Well, what didn't he tell? What did he leave out?
What did he leave out?
He didn't pay his taxes. Now, if Uncle Junebug, wherever you live, I'm in Philadelphia. Now I'm here in Georgia, North Carolina.
That's right.
Pretty much
pay our taxes.
Pretty much everywhere I've ever gone in the country, mortgage or no mortgage, if you don't pay your taxes, there's going to be sheriff's sale, tax lien sale. You're going to lose your home. Now, but that doesn't make a good story at the barbecue. If you say I drank the tax money away, or spent it, or I was irresponsible, nobody want to hear that. Now, we all know Uncle Junebug had a drinking problem, but we don't say that. So he says, I got a reverse mortgage and I lost my house. But he didn't say that had nothing to do with the reverse mortgage. He didn't say the township started the foreclosure proceedings because I hadn't paid my taxes in 4 years. You see, folks, sometimes we hear these stories, Joyce, and it gets people all excited. They done gone back to Reverend and testify and talk about how dangerous it is. And the book of life says, my people are destroyed because of lack of knowledge. See, if you don't know something, but back in Kentucky, we've just said, you're just ignorant. But the one thing about ignorance is contagious. Because if you don't know something and then you tell your best friend everything you know, now they ignorant, and it's multi-generational.
Right.
Ignorance just goes. So before you know it, something that could be helpful to
Right.
a retirement income plan, it's filled with misconceptions and mythology. And all it takes really is just 20 minutes.
Right.
And we do, and we've done it with several of your
that's
clients.
exactly why. That's exactly why I'm glad you're on this show today, Don, because it does start with education. And my clients know at JP Financial Group, we take an educational approach to the retirement planning process. And we look forward to sharing information with our clients and giving them options and explaining things. And as we say, put the conversation on the table, and then you determine whether or not you want to, keep it on the table or take it off. But you become knowledgeable and informed, and you can make a decision. So again, guys, you're listening to the Proactive Women podcast. And my clients know that I'm available to answer questions and at a phone call or email. But a lot of times I hear that people have friends, coworkers, family members that don't have a trusted financial resource. So we extend Ask Me Anything. So you can call, you can schedule a calendar appointment, ask me any question. And it could be anything from what to do with my 401k, or I need Medicare, or what we're talking about today. How do I get more information on how to use housing wealth? What's a good way that I can leverage my housing wealth in my plan? So you can call and ask me any question. It is no cost. It's no obligation. It's just an opportunity to get your question answered. So I look forward to hearing from you and on that call or through a calendar link.
Thank you for listening to Proactive Women, helping create financial legacies for ladies. Oh, and men too. Be sure to visit jpfinancialgroupllc.com. Call Joyce at 704-543-6269 or email Joyce at jpfinancialgroupllc.com. You can find us on all your favorite platforms. Be sure to subscribe to hear more proactive wisdom on wealth from Joyce Palmer and JP Financial Group.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.